Welcome back to Uncontested Investing. I'm Tim Harris. Thank you for swinging back by. Today, I'm with one of the smartest people I know, Daren Blomquist. Daren, thank you for being here.
Thanks for having me. It's great to be here.
All right, so I'm not going to call you a nerd, even though I kind of think you are, and I am too, and I'm proud of it.
I don't take that as a diss.
I find great comfort in numbers, and I think after 20-something years of buying houses, I find that if you can ignore the headlines and dive deep into the data, a lot of times I sleep better at night.
Yeah, that's where the security. That's my security blanket as well. Yeah,
right. So if you would just take 60 seconds, kind of tell the audience a little bit about yourself.
Sure. I'm at auction.com right now. I've been there for 4 years. I get to dive into the data there, and it's wonderful. And before that, I was 17 years at a company called Adam Data Solutions, which I'm sure you're familiar with.
Oh yeah.
Looking at public record property data, and before that, I was actually a journalist. That was where I started my out of college as a journalist working for a newspaper. So that's a really brief history of my career. But I think that journalism outlook actually helped me as I got into the real estate. I kind of fell in, like a lot of other people, into the real estate space. And that journalism outlook has helped me to ask the right questions, ask good questions, and interrogate the data, not necessarily trust what people are saying all the time.
Well, I love that, and I want to dive into that. But I agree with you that need to tell the story probably helps you maybe peel that onion back an extra layer where other people won't.
Yeah, that's right. And there's two sides of it. It's like not necessarily trusting what people say, but looking at the data. Trust but verify, as Ronald Reagan said. But also on the other side, humanizing some of these stories and bringing a narrative to when we tell the story of what's happening in the housing market, as opposed to just here's a set of numbers to look at.
Well, so this episode will air in October, just so you know. So next up, the first segment of the day is called The Bluff, the bottom line up front. So attention deficit society, a lot of podcasts, people start, they don't necessarily finish. And I like to take up to 2 minutes and let the guest tell the audience kind of the most important things they're seeing in the market, kind of the things that you feel people should be paying attention to, maybe things you think people should be avoiding. Just in essence, the cliff notes of what we'll talk about for the next 40 minutes.
Okay.
Good to go?
Yeah, I think I can handle that.
Go.
All right. All right. The bottom line up front for me is I really pay attention to what our buyers on auction.com are doing. To me, they are the frontline watchmen of the housing market. They're telling us, and watch women, I should say, they are telling us what's going on the front lines of the housing market. These are folks who are the typical buyer is someone who's buying, 10 properties or less a year, at least from our platform, and they're buying in their local market within a 100-mile radius of where they live. So they know that market very well. So what they're telling us, at the beginning of this year, they were very cautious. The end of 2022, they understandably, the interest rate shock hit. They pulled back. We saw their bidding behavior become much more conservative and much more limited. But they also signaled this kind of rebound that we're seeing in the housing market. They signaled that early this year, and we've seen that play out in the retail housing market. They had what I'd call, they were cautiously bullish. And they continue to be cautiously bullish, but they have what we're seeing now develop with these buyers on auction.com is that they're staying very disciplined. During the pandemic, we saw some crazy bidding behavior on our platform, which indicated people were just a little bit out of touch with reality, maybe, and caught up in the frenzy of what was going on with the low interest rates and the low inventory situation, and the desire to, go out and get that 50-acre ranch in Montana or wherever, because you can work from home. But that has subsided, and now we're back to kind of reality. And so what our buyers are telling us about the market going forward, I think, is that we're going to potentially see actually a double dip in this market in terms of maybe pricing over the next 12 to 18 months. And but it's still, at the same time, it's still a very good market. The fundamentals are there in terms of supply and demand. And so our buyers are continuing to be cautiously confident. And so that's what I think we're going to see play out in the market over the next 6, 12, 18 months.
So this is why I love listening to you talk. The frontline folks, I agree, are starting to they're feeling like, hey, this may be a buying opportunity. This could be, because if rates do go down from where they are, because now we're like at the point where we're over the 50-year average. For the last 18 months, rates aren't that high. I mean, we're still below the 50-year average, but now, we're getting over 7.75.
Yeah.
And okay, rates are high.
You can't deny it. Rates are high.
Yeah, rates are high. So when you think about rates going down potentially in the next 12 to 18 months or 24 months, whatever your school of thought is, it means there could be opportunity out there, or you could be buying kind of in the trough. What did you mean by double dip? Let's dive into that.
Yeah, so...
Because I was taught not to double dip.
What's that?
I was taught not to double dip.
Oh, yeah. When you dip a chip, you dip it once and don't dip it again.
Right.
Yes, but we prefer to not have double dips in the housing market as well. But I think just what I mean is really we saw, and there's a lot of ways to look at home price appreciation at the local level, national level. But if you just look at the NAR data as kind of a baseline, we did see a dip in home prices, a slight correction in home prices this year. We saw about 5 consecutive months of negative home price appreciation on a national level. But now we've seen 1 or 2 months based on the NAR data where it's recovered and it's gone positive at a very low rate. All I'm saying with the double dip is I expect that potentially to go negative again after maybe a few months of being positive based on this buyer behavior we're seeing on the auction.com platform. And it's really a specific metric that I look at that's the winning bid as a percentage of after repair value, what they're willing to bid, what they're willing to pay as a percentage of value has actually started to, it bounced back at the beginning of this year, but it's actually started to curve a little bit lower. And that's an indication to me of a potential double dip.
I said on a stage in, I think it was June or July, I said, hey, a lot of you guys are getting a false sense of security right now. I'm talking to individual investors. I was like, I feel like it could be a dark winter. And I think you're starting to definitely see that on anything above median home prices. I mean, with rates kind of going where they've gone, and now the property tax, like specifically in Texas where I buy most of my stuff, now the property tax bills are set in stone as of July. And a lot of these houses, I mean, I've got houses where the property taxes double. And
crazy, yeah.
So that so it's you add in the affordability of rate, you add in the affordability of property taxes, then you add in the affordability of insurance increases.
Yeah.
And it's kind of a triple whammy, if you will. And that's going to, I think, if I was buying on the auction platform, I'm trying not to buy single family anymore. But if I was buying, I would be in line with that mentality. Like, you have to protect your upside right now because specific geographies definitely are more at risk, or even specific price bands is kind of what I'm thinking.
Yeah. Some of the buyers I've talked to, they've shrunk their buyer box to accommodate that, or to account for that. So they're being protective, they're being safe, they're sticking with that, depending on the market, under $350,000 after repair value property, to make sure that they're very safe when they go. Their exit of that property, is pretty safe still, because there's a lot of demand under $350,000, under $250,000 in some markets, which you can still buy on the auction.com platform. By the way, you can still buy that band of property, believe it or not. But yeah, that's what there's still a lot of demand. There's a limited supply of distressed properties out there, just like there's a limited supply on the overall retail market, but the buyers are being disciplined. which we didn't see in 2021, late 2020. There was kind of this frenzy in the
when you could refi at 3.5% on an investor mortgage. I mean, it was okay to be a little risky. Yeah, I mean,
yeah, but we see. I think part of it has to do with the nature of the market. Part of it has to do with you had some buyers who jumped in during the frenzy who have pulled back out, and now you're left with the type of buyer who's been in the market for 20, 25 years, like yourself probably, and
it knows how to do math.
Yeah, who knows how to do math and knows that there are cycles in the real estate market and is somewhat patient, and so is more disciplined in how they're bidding on our platform.
You talked about the National Association of Realtors kind of monthly housing report and how a lot of the headline is always the national increase or decline. And one of my favorite things to do is in that report, the first thing I do is go to the regional breakdown and see, how did the West, South, Northeast, and Southeast do, right? And oftentimes those have been positive when the headline number was negative. And I've been telling investors, be aware of that, right? If you're in the West, and we'll just say Denver or really anywhere in the West, but not like Fresno or whatever. But anyway, if your market is declining or at risk for decline, the beautiful thing about a platform like auction.com is I can literally kind of look over the mountains, look into a different market, and use that data to tell me where maybe I should be bidding on assets, right? I mean,
yeah.
And I think that's always the message I tell people about data. Data may be boring to you, it may be confusing to you, but if you learn to look at it the right way, it's the ultimate roadmap.
Yeah, absolutely. And we do have most of our buyers stick within their market, but even within their market, they can change where they're buying based on what's available. I mean, talked to an investor recently in, say, Chattanooga, Tennessee. That market was becoming overheated. So he went across the border. It's right on the border with Georgia. So he started buying in rural Georgia, where the prices were more to his liking and it wasn't overheated. And so you can, the beauty especially of the auction.com platform is you can change location and you can go across the country for that matter. But we actually have a great heat map if you want to go to auction.com/in the news. I post a lot of my research there and recently put up a heat map that shows by metro area kind of this pricing piece that I just talked about at a national level and which markets based on our bidder behavior are most at risk for a potential double dip or price correction.
So I know that website very well, and I cheat. I'll take the articles you publish, I drop them into ChatGPT, and I'm like, summarize this. and
I should do that.
I'm telling you, it's fun for me because I can digest 10 times the data, and oftentimes you'll put out a report, and then I'll go find something on SoFi, because SoFi puts out a lot of consumer-oriented data, and then I'll go grab a Redfin article, and I'll put them all three in. I'll say compare and contrast the viewpoints. Right?
That's great.
Really,
I love that.
Really, just trying to make sure that I'm not. I've been known to be a little too committed to what I believe, and I like to just make sure.
I want to acknowledge that, right?
Oh yeah, I mean, after 20 years, my wife's taught me best. But yeah, it's. I love to do that. I love to look at your articles because they are investment focused, and that's obviously my focus. But then I like to go cross check it. What are these consumer facing platforms saying? I want to switch to the massive wave of foreclosures that are coming. How's that working out for everybody?
Well, there's a massive wave of foreclosures coming. We just don't know if it's in the next 20 years or 40 years.
Well, with all the 40-year loans they're giving everybody, maybe
that's right.
40 years.
Yeah. So, I mean, there was a belief, and even, we potentially, bought into it a little bit at the beginning of the pandemic that this is going to trigger at least another surge in foreclosures. And that, as we all know now, never materialized. I think there's some good reasons for that. But yeah, I mean,
the politicians.
Yeah.
Sorry.
There's a lot of patting on the back going around in Washington about how the forbearance program did prevent the massive wave of foreclosures. I do think when I've looked at some of the data and you try to take out the forbearance element, the shock to the economy was so short-lived that we probably wouldn't have seen a massive wave of foreclosures even without that that forbearance program and moratorium. But that certainly, I think that helped. But
It was a solution looking for a problem.
there you go.
Yeah, I mean, that's all it was.
There you go. So, we're still not seeing that. The data is not pointing to that. I was just at a conference with a bunch of mortgage servicers, and there's a double prong element to there not being a massive wave of foreclosures. In fact, we're still at a point where completed foreclosures are about half of what they were prior to the pandemic, which already was at a basically 20-year low. So, not only are we seeing a massive wave of foreclosures, we're not seeing even the level that we were seeing prior to the pandemic. But the two prongs are, number one, and this is a quote, I won't name who it was, one of the servicers saying, we're terrified of the CFPB. So
Aren't we all?
The CFPB being the Consumer Financial Protection Bureau, and they have been very aggressive in going after servicers in this administration, and also specifically, just publicly saying we do not want any foreclosures happening that are unnecessary, and especially on homeowners who have equity in their homes. And so that's the second prong of this muted foreclosure level, is that there is a lot of equity. Homeowners have a lot of equity, and servicers don't want to foreclose if that equity is there. And so that's keeping things at that 50% of pre-pandemic levels.
So that's going to be a good spot to take a break. And when we come back, I really want to talk about like kind of the differences in delinquency versus like foreclosure and pre-foreclosure. And then you were saying some fascinating things earlier before the show about the different workouts and solutions that people are taking advantage of. And ultimately, I'll put your feet to the fire and we'll decide whether or not that's a good or a bad thing. So stick around. We'll be right back. At RCN Capital, we know that time is money. With our competitive rates and quick turnaround time, you can receive funding in as little as 10 days. We offer flexible payment plans to relieve the pressure of repayment process. Our team is experienced in making sure that you choose a loan that will suit you best. Get on the phone with the loan officer today by emailing info@rcncapital.com or clicking the link in our bio. Welcome back to Uncontested Investing. I'm still here with Daren Blomquist. Daren, as an individual investor that I'm not a smart man, we grow up in this industry where people they say, oh, we'll buy foreclosures. Oh, we'll buy pre-foreclosures. And some of the data can be confusing at times because you read, oh, foreclosures are at a, 50% increase and all this, and they may be talking about starts, or they may actually reference delinquencies, but earlier they were talking about foreclosures, and then you just talked about completed foreclosures. So maybe you could just like treat the audience like they're me and talk about the different stages of this default servicing, I guess, industry out there, and then kind of how you're looking at the trends, and maybe, hey, if you got any advice on like which phase people should focus on, like if they want to find distressed inventory, maybe sprinkle some of that wisdom in there too.
Yeah, I mean, our bias is going to be buyonauction.com, but no, I can get a little bit more unbiased in that, I think. And so, yeah, the way that we look at the world when we look at the distressed market, actually, we call it the distressed market funnel. And the top of the funnel is seriously delinquent loans that are at least 90 days late on their mortgages. And I'll just put numbers around this rather than percentages, because I think that's maybe a little bit easier to grasp. And I'll start actually even with a bigger number, which is there's about 53 million active mortgages in the country.
Okay.
So that's the top of the funnel. That's where these delinquent mortgages come out of.
I got to stop you there.
Yeah.
So there's 50 million mortgages on how many properties total in the universe?
I think it's, I think that's about out of 80 million single family residential properties.
Gotcha. So roughly 30% are 40% are free and clear.
Yeah, it's crazy.
Okay, so roughly 40% of the houses, 30 to 40%, I are not math guy.
5/8.
Yeah, are free and clear, and then there's 50 million-ish mortgages. Okay, continue.
Yeah, so you have the 50 million mortgages. Out of that come seriously delinquent. There's at any given point about 2%, a little 1.5% to 2%. Sorry, I said I wouldn't use percentages that are seriously delinquent. And so right now that ends up being, based on the seriously delinquent rate, that ends up being about roughly 900,000 seriously delinquent mortgages.
We'll call it 1 million because I like round math.
Okay, we'll use 1 million. Out of that 1 million, going further down the funnel, you have foreclosure starts or foreclosure inventory, and that is produced by foreclosure starts. And so in the second quarter of 2023, that 1 million seriously delinquent produced about 115,000 foreclosure starts.
Okay, so in Texas, a foreclosure start, would that be when they send the first, I don't say I get, when they send that first letter from the attorney's office, or is that when it's posted at the courthouse?
Well, it depends on who you're talking to, but generally it's either when the loan is referred to the bank's foreclosure department.
Gotcha.
Or if you're using the public record data, it's when that's actually recorded at the county as a notice of default or a notice of sale.
Gotcha.
So it can vary a little bit. We're actually, for that 115,000, I'm using MBA data, which is based on their survey of lenders, of servicers.
Perfect.
And lenders. So you have the 115,000 produced by, in a given quarter, 115,000 foreclosure starts produced by 1 million seriously delinquent. Now, the tricky thing is there was about the same numbers back in Q4 2019 in terms of seriously delinquent loans. There was about 1,900,000. But that produced back in 2019, those 1 million SDQs produced double the number of foreclosure starts.
So here's where the conversion metrics get a little wonky.
Yeah.
So you still had the 900,000 to 1 million people that were 90 days or more past due, basically. But back then, you would have been looking at 200,000.
Yeah, and I just realized I got the numbers wrong, sorry. But I'll catch it right now.
Yeah.
The 115,000 was back then. Now we're seeing 70,000 foreclosure starts. So about roughly half, a little bit more than half foreclosure starts produced from the same bucket of seriously delinquent. And then going further down the funnel, you have also about half. Right now in the first quarter, or excuse me, the second quarter of 2023, you have about 20,000 completed foreclosures produced out of that 70,000 foreclosure starts. Back in 2019, we were seeing about 50,000 completed foreclosures produced by the 115,000 foreclosure starts.
So now are we done with the funnel?
Yeah.
I like the funnel.
I love the funnel.
How many of those hit auction.com?
About half.
About half?
Yeah.
Okay. So if I want to buy a foreclosure, meaning it's being sold at the trustee sale or whatever, auction.com gives me a 50% chance of seeing any foreclosure in America.
Yeah.
Ish,
yeah.
Ish.
In places like Texas, it's probably going to actually be a little bit higher.
Okay. So there you go. That's a great reason to sell being on the platform. I want to back up, though, to maybe societal behavior, customer behavior, political behavior. It sounds like the customer is acting about the same as they did before the pandemic, right? So because kind of the seriously delinquent SDQ, which DQ is delinquent, right? So
yes,
seriously delinquent.
Seriously delinquent.
Acronyms, you got to pay attention.
Yeah, I'm trying to be careful there.
I love acronyms. I'm a Marine, right? So like acronym world. All right, so we're seeing the SDQs are the same, but there's a 50% fallout to the next phases of the funnel. Could you talk about what's changed in that phase?
Yeah, what's changed is that you have what we talked about a little bit earlier, that servicers are extremely terrified of improperly foreclosing, and they're terrified of the CFPB. And, that's kind of the fear side. I think the positive side is that they are very committed, more than they have in the past, to actually trying to keep homeowners in homes if they can at all possible. And that equity, especially with the equity component that homeowners have, leveraging that equity to keep them in homes. So I think those are the main reasons that we see. And again, I just asked the servicers yesterday at the conference, why do we see this change in the funnel from pre-pandemic to now? And that was their main answer. I would say the third part is that they say that there's a lot of folks who are just, I hate to use this terminology in a way, but it's very, very vivid. They're kind of circling the drain. So people are just, who are in default, are going in and out of default and staying in that seriously delinquent bucket, but it's just taking them longer to move down the drain.
They hit 120, then go back to 90. They hit 120, then go back to 90.
Got it. And because there are a lot of programs available out there, there's another program that's become more prominent now is the Homeowners Assistance Fund. I don't know if you've heard of that, HAF, which was passed during the pandemic, $50 billion nationwide allocated to help homeowners in facing foreclosure to basically just get a grant. This is not a loan. This is, you can get $50,000 to just pay off your mortgage if you show that you need it, basically. And some states have it was allocated to states based on their perceived need or their perceived volume of potential foreclosures. And some states have used up, like Florida's used up 90% of their HAF funds, but I think Texas is more like 50%. So it varies a lot from state to state. And that's something that, a homeowner will go delinquent. They will say, okay, I'm in trouble. I will apply for these HAF funds. They'll get a grant, and that will get them out of trouble, at least for the short term. And then there's other programs that are being proposed that we can talk about if you'd like, that even go deeper into helping these homeowners avoid foreclosure. The question is this really just kicking the can down the road like we've seen in the past, or is it actually going to permanently help these consumers? A lot of the servicers I talked to yesterday are saying this is just delaying the inevitable for a lot of these consumers.
Yeah, and they're just, ultimately my opinion is that it just means that they're getting more derogatory marks on their credit for longer. Than just kind of.
And from my perspective, the government likes to hit up on, to beat up on investors for lots of things, but one of the things is so-called equity stripping, like going to these homeowners who are in foreclosure. And by the way, we can talk about that. You asked about the opportunities, and we can talk about that too. In that funnel, there are different opportunities for investors, but one of them is in that what you'd call pre-foreclosure, when they're in the foreclosure start bucket, but they haven't made it to completed foreclosure. Investors going to those homeowners and, the so-called practice of equity stripping, where they will, basically buy that property for a discounted price, and the homeowner walks away without really realizing the equity that they have in the property. But in my view, some of these programs that the government is proposing to keep these homeowners in the home is actually equity stripping. They're leveraging the equity the homeowners have to keep them in the home. But at the end of the day, if they end up just pushing the can down the road and they end up getting foreclosed on, they're going to lose the home and they're going to lose their equity as well. They're going to be equity stripped. They have equity now, but that equity will be gone by, 5 years down the road, potentially.
See, and I think that that's a great point that the customer needs to hear, my investors, right? You need to learn to talk around that, right? You need to learn to tell the customer, hey, there may be opportunities out there, but it may end up being the same as if you took a discount now. But the bonuses of discount now, hey, you're going to stop ruining your credit. You're going to avoid a foreclosure. You're going to get your equity now and be able to restart your life. Some of this stuff that's kicking the can down the road, like you said, is silently stripping their equity out and ruining their credit further. And ultimately, they may end up with no equity and then actually still have a foreclosure on their record.
Yeah, I totally agree. But I do also want to acknowledge that there are bad players in your world. Sorry to say that, who have given, some investors a bad name. But there are also really good players who are doing the right thing. And I'm thinking of one gentleman in Houston that I talked to who buys off of auction and also off of other platforms. And, he sees him buying at foreclosure sale is actually a more efficient solution for some of these homeowners than if they tried to stay in the home for, another 5 years using some of these programs. And, he has examples where he'll buy a property at foreclosure. I actually went to a property he bought at foreclosure for over $30,000 over what was owed on the mortgage. And so what that does for the homeowner is they actually walk away with those surplus funds. It's called surplus funds.
Yep.
So that's their, they actually, a lot of people I don't think understand this, that the foreclosure sale is the last opportunity for that homeowner to protect their equity. If it goes back to the bank then the bank sells it, the bank gets all that equity.
Right. Because at that point, it's not real estate owned. It's not an REO at the foreclosure sale.
Right.
It's the property's being sold. If the bank's the only bidder or the highest bidder, then they take it back. Then they become the owner.
Exactly. And so then they sell it. And if they sell it for $30,000 over what was owed, they take that. They pocket that. So this gentleman, and he does this consistently. But this specific example, the homeowner was living in the home. He couldn't afford the mortgage. So this investor bought the property for $30,000 over. The homeowner walked away with, a check. It may not have been exactly $30,000 because there's some
cost,
some cost there. But they walk away with that equity, and then also the investor is willing to let the homeowner stay in the home for an extra 30 days to be able to have a graceful exit out of the property. They get that extra 30, 60 days, and then they have 30, whatever the number is, $30,000 in relocation or to help them get back on their feet. That could pay for rent for at least 6 months, 6 to 12 months. So there are some benefits that to kind of ripping the Band-Aid off and saying, hey, look, I can't afford this home anymore. And so facing that reality sooner rather than later.
So before we take our next break, I do want to make sure that we put a button on the foreclosure funnel, which we've got to turn this into an infographic, by the way. Do you foresee in the next 24 months the number at the end of the funnel being higher or lower than it is right now?
I foresee it being about the same in the next 12 months being about the same, possibly 24 months. We'll start to see that number go up. And so that's the short answer.
That's why I said 24 months. I took you past the election. I took you all the way past the election. I took you all the way past the politics, the engineering, the interference with the natural cycle of things. Because I'm a proponent. I don't want anyone to ever lose their house. I really don't. But the more we get back to like that natural balance in the market, the more healthy the market is for the long term for everyone. Not just for me as an investor, not for you as a auction provider. I mean for the homeowners, for the people that want to buy homes and sell homes. Like there has to be an equilibrium. And right now I feel like it's still, we're way out of whack and we're interfering too much in governmentally interfering in too much that is none of the government's business.
Yeah, and there could be some bigger consequences to that if that continues for the long term.
Yep. I'm all about the free market. So we're going to take a break. We'll come back, do the Money Minute, and talk about more opportunities for investors and see what else Daren has to say. So stick around. We'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-vest.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. I'm Tim Harrods. Thank you for sticking around. Now it is time for the Money Minute. Daren, this is my favorite part of the podcast. 60 seconds. There's an investor out there. This is the only advice, only information, only data, whatever that they're going to hear for the next 30 days. So it's got to be the best advice you have for the investors today. You ready?
Okay, there's a little pressure there, but yeah, sure.
Go.
All right, my advice to an investor looking at the next 6 to 12 months in this market is, first of all, look at the data. Don't put your head in the sand. Be aware of what's going on. We've got a lot of good data on auction.com. There's a lot of other sources of data. I love this idea of consolidating data, looking at different sources. Everybody has a different bias, and consolidating that, and so that you're getting a hopefully objective, unbiased view. And the number two, big thing I think for a lot of investors out there, if you don't have this already, is get a mentor. Someone who's been in the investing market longer than you. Maybe you've been in it for a few years, and find someone who's been in it for a decade or 2 decades, who's gone through a couple of cycles, who can give you advice on how to handle what's going on in the market. And that would be the, very important piece, especially if you're dealing with a more, niche product like buying at foreclosure sale. You want to have someone who's done this before and done it before in different cycles, and that will help you tremendously.
So I love that. And there's so many people that come on this show and talk about, hey, get a mentor, right? And it doesn't have to be someone you're paying $50,000 a year or something. I see a lot of these trustee sales down here at the Dallas courthouse. These people become friends, right? They're adversaries when they're bidding, but they become friends. They know each other. They ask each other, hey, what's going on in the market? So I think it's very important. Like if you're out there and you're thinking you may want to buy at auction, like go talk to people that buy at auction, and not people that want to buy at auction, like people that have been buying at auction, right? Like here in DFW, George Roddy is like the most experienced auction buyer ever. His dad created the Roddy Report, which was like the gold standard before you guys came in with all the data and technology.
They still have a lot of great data.
Yeah. But find someone that has been through it. And I hate to beat the dead horse, but if we do have a double dip and rates do stay as elevated, I'm starting to think the 30-year mortgage could hit 8%, as the minimum, not just like the high number. And, that will affect whatever your exit strategy is. So I think that's great advice. And on that note, we talked a little bit about some opportunities for maybe some, I call them pre-foreclosures, like after the foreclosures start, once there's that notice of default out there. We talked about clearly buying at auction, but following the data. Did you read the RCN Capital Investor Sentiment Report?
Yes, I've seen it. Yeah.
So like a lot of investors, their biggest struggle right now is inventory, right? You guys have half the inventory you used to, right? And you just got through saying you don't really see it going up a whole lot. Looking at data, looking at regions, do you have any advice on maybe where some opportunities are for the person that wants to buy real estate at a discount?
Yeah, and this isn't necessarily good for auction.com, but I would say move up funnel is one thing. And because of what we've talked about, the funnel kind of being clogged at the top, is more opportunity at the top of the funnel. So I did an analysis of in 2022, there were about 85,000 completed foreclosure sales for the whole year. But there were, if we look at properties that started the foreclosure process, but then didn't make it to foreclosure sale and sold prior to foreclosure, that was almost 150,000. So you have, and that was not the case in previous years. We saw a definite shift in the last few years where those pre-foreclosure sales actually exceeded the foreclosure auction sales. We've seen a shift even more dramatically away from the REO sales, the properties that become bank-owned and sell from the bank. So I think number one thing would be, at least in the distressed space, is to move up funnel to find those opportunities. There are still plenty of opportunities at the foreclosure sale. But use, my one piece of information advice there would be to use technology to your advantage, and the ability to buy remotely using auction.com and other services to find that inventory, maybe in markets that you've overlooked or a little bit outside of your usual scope.
I want to go into some rapid fire here real quick. Median home price, how important is that when you're making investment decisions, do you think?
Well, the trajectory of the median home price is super important because that tells you what you're going to be able to exit at down the road. And then it's also very important in terms of, what you're buying at and what the market is for that price range in your area.
And right now, I hear a lot of different numbers about household formation and number of housing units we're short and all that. Do you have any numbers you can share there?
Yeah, actually, I've done my own analysis of that, and I do. Yeah, the story is true that we have undersupplied the market over the last 10 years. However, if you look over the 10 years ending in 2020, if you look at the last 3 years, though, we are on a trajectory, if some of the projections hold true in terms of household formation, to have an oversupply by the end of this decade. So that we are in an undersupplied situation that could, the pendulum unfortunately tends to swing, and so that is starting to swing backwards. So just be on the lookout. Don't necessarily buy into that undersupply story for the long term, at least.
I look at saturation, and it's one of my concerns with like self-storage investing, and even I've been looking at a lot of the Colliers multifamily delivery reports, and you start seeing a place like Boston's got like 300,000 units coming. Some of these numbers are huge. And I look at what we did in the 80s, right? Coming out of the hyperinflationary times of the 70s and early 80s, we just built a metric ton of multifamily and then ended up with way too much of it by the end of the 80s. And then the 90s, I argue the 90s, which was a relatively flat period for home prices, is kind of what we have coming in the next 7 to 10 years.
Yeah, I think that could be a possibility. And depending on population, the Zelman and Associates has done some really good research on demographics, and they're really actually even more pessimistic about household formation because of population growth slowing pretty dramatically due to, fewer kids being born per family and less immigration potentially. So those are big picture trends to look at for the longer term. When it comes to the supply issue, I would say, make hay while the sun shines right now, because we are in a nice environment where that undersupply is like cushioning the market, but that could swing.
Yeah, because the boomers are going to die, ultimately, eventually.
That's terrible.
It is what it is.
Yeah, that's true.
And then I'm a unique. I'm 45, and I have these nephews and nieces in their mid-20s, late 20s. And they're not getting married, they're not having babies. They're like renting and moving around. So I agree with you. I think that we could end up with a population decline situation, kind of maybe not now, but soon, and that will, like you said, will change the dynamic. Specifically, if we rush to overbuild. So, hot take: what is a market that you think is underrated right now that an investor that uses maybe data and technology should look at?
Oh boy. I was just looking at some of these markets the other day, and, these are markets, the demographics are tricky here in terms of population change, but, in some of the best opportunities we saw on our platform for returns are places like Chicago, Cleveland, Detroit, some of those Rust Belt cities. There are dangers there, there are risks there, but in terms of buying, a lot of distress at a discount, those are great markets.
I almost got mugged in Chicago last year. I agree with you on the danger part. And what are some markets that you think may be overrated right now? And don't say Austin. I'm tired of hearing it.
No, I think a lot of this around where I was just talking about, through the center of the Southeast, if that makes sense. So around Atlanta, Chattanooga, Nashville, those markets extending. Those are some of the markets that have attracted a lot of investors, and so there's a lot of competition, and we're seeing some, what I would say, maybe overpricing there.
Yeah, because they used to really just be flyover markets, right? Like you kind of like flew over them and didn't really like pay much attention to them, and then all this. And now you got Zoom telling Zoom employees that they need to come back to the office, right? So I'm not sure you can work from Chattanooga anymore and have a great job. So I completely agree. Well, we're almost out of time. Is there anything we haven't covered that you think would be advantageous to cover?
No, I think I'm sure there is, but can't think of it right now.
So let's talk a little bit. Let's pay the bills. Let's talk a little bit about auction.com. Obviously, I can buy properties that are at the foreclosure sale. Obviously, you have a lot of data, auction.com/in the news. Anything else about auction.com that you can share?
Yeah, I'll share. I mentioned technology earlier. I think one thing that people may not know about is we've launched this during the pandemic is the remote bid feature for our foreclosure auctions. So in the past, 100% of foreclosure auctions, you had to be there in person or have a proxy there in person to bid on the properties. And now it's not available everywhere, but it's available in Texas and about 1,000 counties nationwide, is you can actually use our app to bid at the foreclosure auction without being there. I mean, you have to still bid. It's still a time-constrained situation where you have to bid during the actual auction, but you don't have to be there in person. And so that's a great feature that I think many people may not know about that you can take advantage of.
Can I still sell my own houses on your platform?
No.
When are we getting back to that?
We'd love to, to see that open up, and I think there are some plans possibly to do that. But at this point, no. We're focused on selling 100% of what we're getting in the distress market. That's our main focus right now. But we do see, inventory, to your point, is an issue. So we'd love to provide more inventory to our customers, and that would be one avenue to do that.
I sold a house, it was probably a decade ago on auction, and I flew out and I was in the bid room, the war room. It was one of the coolest experiences because you guys you're running thousands and thousands of sales nationwide, and it's a very impressive company. And
that war room experience is pretty cool.
Kudos to you guys for owning the market. There's not many people that still own a market like you guys do.
Well, thank you.
Well, thank you for being here. Thank you, as always, for your insight, your knowledge, and being willing to share, man.
Great to be here. Thanks, Tim.
Thanks for coming in. That's it. We're out of time. Thank you guys for stopping by. We will see you next week. Just remember, your network is your net worth, and today you've been growing both. We'll see you around.
Thank you for listening to Uncontested Investing. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow REI Inc. magazine on LinkedIn and Facebook and RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time.